Overall, yesterday the majority of the stocks in the S&P 500 were down, and we want to focus on a company that has reported their earnings this week, and that is Nike after market close on Tuesday. And this is a company that, as we can see, is down 25% year to date, currently trades towards its 52-week lows, and we also notice 2 buy ratings from Seeking Alpha and Wall Street, although we can see Quant give this a hold. So is this one we really need to consider? It has been hammered significantly. Is there an overreaction? And what value do we believe this company should be a no-brainer buy? Now, first thing to note with their earnings, one thing that was very interesting for shareholders was that they said they will be withdrawing their full year guidance, and on top of that, they will be postponing their investor day, which the anticipation was to see this next month. Now, in terms of the actual earnings, how they performed, well, it was fairly mixed. They actually beat on the earnings per share, as we can see here, 70 cents versus the expectation of 52, so a very good beat. Revenue as well coming in more than market anticipation, 11.59 versus 11.65. However, the disappointing thing to note was here that in fact their reported net income for the quarter was around 1 billion, and as we can see, if we are looking at the same quarter last year, that was around 1.45. One positive thing to note, they did grow their gross margin, although minimally by 1.2 percentage points to around 45.4%. But what we really want to highlight with this company, when we do take a look at their numbers, they have been moving in the wrong direction. Their revenue from this latest quarter of 11.6 billion is down around 10% from the same quarter last year. Their gross margins, as we said, they are up, although very, very trivially. And we also note the major disappointing factor is their bottom line net income is down significantly, 28% from the same quarter last year. We also note that is reflected in the earnings per share, where when you do take a look on a basic as well as a diluted per share basis, it is down 26%. So a lot to consider with this company. Do you believe that the brand is starting to die, or is this purely just a blip in the company's fortunes moving forwards, and do we expect them to continue to be the powerhouse brand that we know them to be? Now, very interesting to note as well, less financial information, but Bill Ackman in the latest quarter, when we did take a look at his portfolio, we noticed he had a new buy in there, which was NKE. In fact, it took up around 2.2% of his overall portfolio, so not a massive purchase, and actually quite unlike him when we do take a look at some of the companies, the industries he's invested in. This isn't his typical purchase, so is it one that in actual fact he sees as very undervalued and decided to get his toes a bit wet and purchase a little bit into his portfolio? Now let's get back to the main point, which is the company itself. As we said, down 24% year to date. Over the last 10 years, however, it is up 88%, and we do get quite a bad downward trend from the last 3 years. November 2021, it was pretty much at all-time highs, $178. Right now, though, it is trading less than half that price at $82.10. It does have a high forward P at 29.63. We're going to shortly compare that to the average over the last 5 years, and a forward yield of 1.8%. Now let's dive into some of the financial metrics. Nice to see 99, very safe score in the dividend safety, highest score obtainable, and they also gave a very respectable increase of 8.8% in November last year to the dividend. We should hear over the next few weeks what that increase will be for this year. Now, essentially, this score was reaffirmed, and what this ultimately means is that a dividend cut is highly unlikely. Now, key metrics is from the recession, or Great Recession, in fact, 07-09. They increased the dividend. They had negative 7% sales, above the average for the S&P at negative 12, and they also outperformed the S&P, negative 36, as we can see, S&P itself, negative 55. We do typically talk about this company being a dividend growth stock, given the fact over the last 5 and the last 20 years, they have been increasing these dividends at a double-digit rate. And we also note 22 years of consecutive increases to the dividend. They're 3 years away from becoming a dividend aristocrat, and they have also been paying a dividend for the last 40 years without a reduction. Now, taking a look at this new valuation model where we do compare the forward P over the last 20 years, when we do zoom in over the last years, as we can see the blue expected fair value tunnel, this pretty much tells us for the majority of the last 12 months, this company has been trading severely in undervaluation, but as always, we do run it through our own valuation model shortly as well. First thing to note, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. Massive undervaluation signal here, 1.8 above the 5-year 1.07. And whilst we do believe the forward PE does sit high for this company at 28.5, given the fact it is growing at a very minimal rate, nonetheless it is lower than the 5-year rolling of 31.9, so that is a double undervaluation signal, although we do note the consumer discretionary sector as a whole does sit significantly lower at 14. Remember though, we're not looking at any one model in isolation. Now, free cash flow payout, we want below 60%. Give us faith, management can offer double-digit increases we love to see. Pretty much below that every single year, 33 in 2024, 52 over the next 12 months. So in November this year, we do anticipate a nice, at a bare minimum, high single-digit increase to the dividend. Then we move on to the free cash flow per share, where we want to see consistent increases over the long term. It's pretty much doubled from 2015 to 2024, so that is nice, although do note the inconsistency on a year-on-year basis. We do have to point out, and really no surprises, the free cash flow is anticipated to drop over the next 12 months to around 284 per share. Now, in terms of sales growth, 3 to 4% at the bare minimum, just to keep up in line with inflation, ideally towards the upper 7% level. Now, this is what we mean. It hasn't grown in the last year full annual accounts. Over the last 12 months, negative 3%. So something just to bear in mind. Ultimately, if you are investing in this company or considering it, then you do believe that they will come back to the ways that we have seen over the last 10 years. And if you want to zoom out, look at it from a numerical perspective, though they have grown their top line from 31 billion in 2015 to 51.4 in 2024. On top of that, returning some excess cash to shareholder pockets through those share buybacks, very inconsistent. In fact, we do note some years, for example in COVID, where they did issue equity, so dilute your position, but net effect is quite nice, as we always say, a little bit of an added bonus. ROIC, one of my favorite and most important metrics, 10% or more, which is what we get on a very consistent basis. Last 4 years in the low to mid 20s. Great sign to see. 22% as well on a trailing 12-month basis. Again, does give us that faith that management are able to effectively allocate their capital. Operating margin, in a dream case scenario, we want to see efficiencies where it increases year on year, pretty much as we want to see with revenue. However, we do note it does straddle around that 12% point. You could argue with more and more competitors coming into this space, they are having to drop those margins further and further, and we can see the decreases from 2021. Free cash flow though looking good nonetheless, above 5% pretty much every year, 13% in 2024. Now this brings us on to the final metric for this part of the analysis, the net debt to EBITDA, referring to the earnings before interest, tax, depreciation, amortization. Now below 3 is what we want to see, and that is what we get, 0.05 in 2024. That is very strong. This is the number of years it would take the company to pay off all of their debt net of cash on hand. So signals to us they have a very strong balance sheet. No surprises to the dividend safety, as this model does correlate to that. And even with the marginal increase over the next 12 months, absolutely no worries, and we will take a look at that in further detail when we analyze the balance sheet. Now, we also want to let you know we have released our latest free weekly article. We drop one every single Monday where we talk about what's happened in the market. In fact, in the more recent one, we talk about 3 stocks we're looking to buy this month. And as always, we do try and cover some stocks that we do believe deserve some of your attention. On top of that, you will be able to grab a copy of our 36 undervalued stocks for the month of October. We run through some information on each one that is very vital to understand and discuss those that sit within our own portfolio. And for this month as well, you can grab 22 undervalued dividend stocks that have the largest upside, and this is according to Wall Street. So go ahead, click below, sign up and read straight away. We also like to look at insiders and institutions. So starting off with insider ownership, 0.05%, and we do notice around 39 million worth of sales by these insiders over the last year. Very trivial buying in comparison of 226,000, and we do note in the more recent quarter, no buys, no sells. In fact, over quarter 3 and quarter 2, we see some significant selling with some very marginal buys in quarter 2. When we want to see who these individuals are for that transparency, we can in fact see that the chairman on the 14th of August and on the 18th of July sold quite a hefty number of shares, 110,000 in one tranche, 52,487 in another, netting him around 12 million. Now remember, this isn't necessarily a bearish signal, we just want to highlight this information in today's episode. And then we do the same pretty much analysis for institutions, 64% ownership, 9.5 billion worth of sales over the last year, with some more buying over the same time period. So they are buying more. However, we do want to point out in the more recent quarter, they are doing the opposite. Institutions are selling more, and it's key to understand that always do your own due diligence, never rely on insiders or institutions. So let's get into some analysis in terms of the income statement, balance sheet. First one, income statement. Now, we've already looked at their top line revenue, but again, just to highlight from a graphical perspective, they have been increasing over the longer term, although we do note over the more recent years, it has started to stagnate, and we can in fact see 51.2 billion in 23, 51.4 in 2024. Now, we want to understand in this part of the analysis, what does the bottom line net income reflect to us? What story does it tell us? And we get a little bit of inconsistency, not something we really want to see. We would expect with increasing revenues, the bottom line net income to increase as well. And whilst it has done from 2015's 3.3 billion to 5.7 in 2024, we can see very, very inconsistent on a year-on-year basis. So something just to bear in mind, perhaps use this when we do come to our margin of safety later on. Now, balance sheet, quick health check, total cash versus total debt. It has increased over the longer term. Again, fairly inconsistent, nearly doubled from 6 billion in 2015 to 10.3 in the latest quarter. And when we do compare that numerically and directionally to their total debt, we can see that has also increased 1.3 billion in 2015 to around 12 in that latest quarterly report. Now look, their debt has been increasing, but so has their cash. And when we did look at the net debt to EBITDA, it did look to be very healthy. But again, just something to keep an eye on. With debt, we do want them to either pay it down, or there has to be reasons which are very valid for increasing in nature. Now then we want to look at their earnings per share, and first thing we want to point out, over the next 3 quarters, they are anticipating negative growth to the earnings per share by double digits. You'd have to wait till Q1 of 2026 before seeing the reversal of positive 18.33%. And what we do quite like is that over the last 4 quarters, they have beaten fairly substantially the earnings per share. Also, on a more positive note, they are expecting growth to the EPS in 2026, which will ultimately bring down that very high forward PE to around 24.8. Now, in terms of some gradings, first we're going to start off with the valuation. Now, no surprises, they do get a D. Main reason for this, their PE on a non-GAAP basis is higher than the sector median. We already discussed this earlier. Pretty much you are paying a 75% premium for this company in comparison. Sometimes you can justify that companies do deserve a premium. Whether or not, though, that is a question you need to ask yourself for this company, and something we see pretty much whichever valuation method you are using in today's episode. Then when we take a look at their growth, they get a D, which isn't really great to see, especially given their valuation is higher than the sector. Year-on-year growth, negative 3%, when the sector itself, even though it is low, is still positive at 2%. When we look on a forward basis, pretty much flat, as we can see here, sector median 3.5%. And one more disappointing feature is that whilst the earnings per share does look okay at 8.2% expected over the next 3 to 5 years, the sector, which does trade at a much lower valuation, is higher at 10.7. Again, just things to consider. Profitability, however, does look good with an A+. Gross profit margins 45%, better than the sector median 37%, and the bottom line 10.6%, better than the sector median at 4.5%. We also very much like their cash from operations, 7.4 billion, with the sector overall 278 million. Now, quick conclusion for this part of the analysis, a double buy rating from Seeking Alpha and Wall Street, hold from Quant, D valuation, D growth, A+ on profitability. Now, final thing before we jump into the valuation, let's see how the industry as a whole has compared. We have Deckers Outdoor, ON Holdings, Skechers, Crocs, Steve Madden, just to compare whether or not there's an issue with this company, or in fact it is the industry overall. So total return, including dividends, we do notice that this company is the only one that has been negative. In fact, the others have had some very, very strong performances. And when we look over the last 5 years, we can see the only one with negative returns. So this is an issue isolated with this company. When we zoom out over the last 10 years, though, we do see it in the middle. So not really great performance over the last year, 5 years. Over the last 10, not the greatest either. But remember, past performance isn't a determination of the future. So just something to bear in mind. Whilst it hasn't been great 10 years, maybe this could be a value turnaround play that could benefit moving forwards. Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So our intrinsic value of $101, how we got this? Well, we ran it through three models. The first one, the multiples valuation model. Companies in a similar sector and size, the average P of them multiplied by the EPS of Nike, and we can see pretty much an overvaluation, although not too far off the market value. But as always, we don't look at any of these models in isolation. We then have the dividend discount model. They do increase their dividend at a very respectable rate. We want to be conservative today though, 6.25 moving forwards, and we do get a marginal undervaluation signal. We then move on to the DCF model, free cash flow year on year. Average growth very high at 36%. We've gone pretty lower than analyst expectation at 9%, which is also lower than the last 2 years. Using the discount rate, we then get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see here, an undervaluation score, which is pretty strong. So in terms of the intrinsic value, it's just the average of these three models today, coming at $101. And as always, you can grab a copy of this model by clicking on the pinned comment below to run your own numbers through, whether it's for NKE or any others. So margin of safety, we always use one on this channel, 10%, execute on that if it meets the three golden criteria: wide moat, strong financial metrics, good forward-looking data. Look, if you believe that, we'll buy up to $91, then we keep going till it's near the current trading price. Now, it's not at the 20% level just yet at the $81 mark. Today, it's sitting somewhere between 15 to 20%. And we do note Wall Street, with that buy rating earlier, their price target a little bit lower than our intrinsic value. They have $94 where they see upside of 13%. Now, you have to ask yourselves whether or not, as we mentioned earlier, this is a blip in the middle of their journey and you do see them continuing to be the powerhouse that they are, or maybe you believe they are starting to lose market share to other competitors and they will ultimately move away from the big name they have had in households. However, as always, do let us know your thoughts below if you're buying, selling, or maybe this is one you are just looking to hold. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter. We're dropping the next one on Monday morning. And as always, come and see us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.